Bill Chapman is on the line. He's in the house. Bill, how are you?
I'm very good, Larry. How about yourself?
Very good. Can you give us some information about what the heck is going on? 70 handles up, 70 handles down. My
Well,
400-day moving average is going berserk. What's up, buddy?
well, I've been spending a lot of time looking through into my crystal ball to find out what's going on in the marketplace. The last time I was on your show was on the 19th of March, and I made a couple of prognostications. And one of them was the fact that I said I was going to make the argument that we are at or near the bottom if the bottom didn't hit yesterday. And I was 2 days off. And the market has just moved right up since. What we had, yeah, just about. What we have here, this was the tip I gave for the day for the spiders, the projected high and the projected low. And what I wanted to do, and what's going on in the market here, is that they're realizing, yes, there is a bottom in place. One of the things that we had discussed last time was the VIX. And I wanted to get into a discussion about the VIX in particular because the VIX is simply a number. It doesn't measure volatility. But there's a great, the VIX is, it measures the implied volatility of the near-term options, index options. So it produces a specific answer to the question of whether my options, are they selling at a discount or a premium? And it's not based on the Black-Scholes models. There's three measures that are used. And it's essentially, there's a time value, there's a implied value, and there's also, and I don't have it right off the top of my head, but it's basically a way in which you can get a good idea of the value of whether your things are expensive or cheap. Mm-hmm. Now combine that with the skew, which measures the tail end of the options, the out of the money options, while the VIX measures the in the money options. If you lay the one line chart above the other, you get these signals of when to buy and sell the market, and especially when you get this divergence happening in the marketplace. So if all of a sudden the skew is going down, but the market's going up, you get a cross here, you're getting a sell signal. Mm-hmm. Skew's coming up, market's moving up. Again, skew comes in, crosses, there's downside action. But the particular thing that you really want to look for is when everything's moving in sync, it's fine. But once you start getting a divergence between the VIX and the skew, then you're headed for trouble. And this was one of the major indicators that I used for myself and for the people that my client base to tell them to start, watching the market very carefully here because we've got a major divergence and we're going to come in. But what we're witness to now with the market going up the way it is that, as I mentioned on the last time we spoke, there's a ton of money out there just sloshing around with nowhere to go. And we've seen most recently that the banks are currently unwilling to give up treasuries that they're sitting on. And they're just holding out in cash. So it's funny, people have been talking, and I believe the gentleman you had on yesterday was talking about the repo funding and how it's gone down from 87 billion to 31 billion. April Fool's Day, there wasn't any repo funding. I think maybe to $2 billion because the banks are unwilling to come to the table and divest themselves of high-yielding treasuries, currently high-yielding treasuries that they have on their books to the Fed for cash. they're currently in a nice stable cash position right now. But what we've seen is a market that has come down, tested, it's put in an island reversal in the S&P, and we're coming up upon 200-day moving averages that the fund managers look for as a determination to make a move into the marketplace. We have, by my calculations from yesterday, we have 711 points on upside in this market. We've got to get through the level of 3069, and if we can clear that, 3411 is next.
That'd be a new high.
That's going to be a new high.
Okay.
Okay. So those are the numbers that I'm looking for. We don't go up in a straight line, but the thing about the market now, and with the programs and the computers running the arena, is that the element of time has been compressed. Normally, 6-month corrections are now taking a month. Just look at the fourth quarter of December 2018, and you can see the way we came in from October right down into Boxer's Day, and in less than a month, we were right back to where we were. And this is the velocity of money worldwide, because money never sleeps.
Bill, we have a question. Could you explain what the skew is again that you were talking about when you were describing the volatility index?
Yeah, well, the skew, it's an index derived from the price of the S&P 500 tail risk. Now, tail risk is calculated by out-of-the-money options. So okay. A value of 100, it's usually valued around 100. That's equilibrium. Anything above 100, your tail end skew, things are expensive. Anything below 100, things are cheap, things are on sale. And as of recently, as you can see from the chart up, that we've been down to 113.10 on the skew. Things are pretty cheap out there in the marketplace. And money has to go to work. You can't be a mutual fund out there and be sitting on cash. Your money has to be out there and in the market and working. Larry, it's been a pleasure talking to you.
Hey,
Sorry
listen,
about
thanks for joining us. We'll have you on again soon, and have a wonderful holiday, and we'll see you later in the month. How's that?
That sounds great, Larry.
You bet. Bill Chapman, Trend Reaction, 877-927-6648.